Welcome to Wealthion. I'm Wealthion founder, welcoming you here at the end of the week, where I'm joined by my excellent friend, Lance Roberts, portfolio manager from Real Investment Advice. So we're going to talk about everything the market's done in the past week, as well as some pretty big macro developments. Lance, how you doing today, brother?
I'm good. It's been an interesting first technically we have to call this the first week of September. It was a holiday shortened week because Labor Day was Monday. So for the first full week of September, it's now over for the most part, and we can kind of start looking forward to what's coming.
Okay. Well, all right, look, so markets pretty range bound right now, right? They're still trying to find their footing here. I know that from the past couple of months, you had first predicted that things had gotten pretty overbought. You said, look, there's highly likely to be a pullback. You said put it at like the 3 to 10% range. We've seen that, not a little more than 3, not quite 10. And markets have then sort of tried to recover, but they're just having trouble finding their mojo. They're having trouble deciding at this point which direction they want to go in. What are things looking like to you? What do you think is more likely from here? Do we break out and start climbing again, or is gravity kicking in?
No, it's just simply the market's doing exactly what you kind of expect it to do. As we talked about in July, to your point, we said, 3 to 5 to 10% correction, completely normal in any given year. We had a 5% correction-ish. Since then, markets have tried to rally here just a tad. And again, as September, we're in August and September, very weak months of the year. Typically sloppy kind of trading action. In September, Europe's pretty much mostly closed down for the most part. So you have a lack of liquidity, a lack of volume. So markets tend to kind of drift sideways. If you go back historically, you'll see a lot of analysis that says, September is one of the worst months of the year, which is true because for some reason, whenever you have a big crash in the markets, whether it's a Black Friday or whatever it is, it always happens in the month of September for some reason. So Lehman crashed in September. So if you strip those out, kind of those anomalous situations that occur from time to time, and why they all kind of cluster in September, I don't know. But if you strip those out, the month of September is still weak, but it's not exceptionally weak. Markets tend to kind of just drift for the month. That typically sets you up very well for that October, November, December period, which are the start of the seasonally strong 6 months of the year. And the reason that is because portfolio managers then have to start putting money back to work. They need to catch up with portfolio performance. They need to be fully allocated as they head into the end of the year for reporting purposes. And of course, this is also when you get your holiday shopping season. So things tend to improve in terms of economic activity typically. And we're also going into a pre-election year. So all of that's going to kind of lay in here that likely this market's going to kind of consolidate here for a month or so. And then we'll probably have a move back towards the July highs as we head into year end.
All right. So I recorded an interview just a couple of days ago with Sven Henrich that just ran on the channel. And Sven, like you, Lance, said, look, I think the macro data is, really pretty dismal in many ways. But he said, if you look at the TA, there is a lot of data, historical data that suggests that stocks actually should end the year higher here. And he said, as you and I, as you've been talking a lot about, this year, is the fundamentals really haven't mattered much to the market's direction this year. It's been a market that's been very driven mostly by TA and narrative. So, Sven has basically said, look, I have a really hard time making a bear case here right now, while this is the case, that the markets are responding to TA and the TA looks bullish. Let me just put up one chart and let you respond then. So he went through a ton of charts, and I'm not going to repeat all every chart that he mentioned. And folks, if you want to go watch that video, you really should to hear Sven's see his litany of TA on this. But one chart, which isn't really even technically TA, is this chart here of seasonality of the S&P. So this is basically the blend of the past 20 years of performance of the S&P. And he said this year has basically played out almost exactly on this trajectory so far.
Correct.
And if you look at it coming in here into September, It actually looks like it should pop up for a little bit and then cool off a little bit in October, and then just make this run into the end of the year here, right? And he's saying, look, who knows if it's going to continue to stick to script, but we're 2/3 through the year so far, and this is how the script has been playing out. So you got to kind of have some respect for this correlation until it breaks.
Yeah. So leave that chart up for a second. Don't take that off, because I want you to look at that run up in that big decline in the market. That's Lehman. So that was when Lehman crashed. And so when you have these kind of outsized movements in the markets, it tends to kind of skew the data. September 18th was Lehman. So that's kind of where you are on that clock. So again, you strip that out, that you don't quite have that big bump. It's more of a sideways trend. But very importantly, if you look from the beginning of August through the end of September, market kind of goes nowhere, and you strip out that Lehman moment, then you kind of get the better picture. But again, it's just where we are right now. Again, it's that seasonality play that we're talking about. And then at the end of the year, it's positioning and that type of stuff for the bulls. Real quick, I didn't mean to interrupt you, but what you said was very key to the overall view. You said, well, you take a look at the fundamentals. The fundamentals are pretty dismal. Fundamentals are terrible short-term indicators because it takes a long time for the markets to recognize the fundamentals. And so when we talk about things like valuations or fundamentals, these type of things, this is what gives you the best idea of what your returns will be over the next 5 to 10 years. So if I look at the fundamentals, I look at the valuations, stock returns are going to be very low over the next 5 to 10 years, X a massive surge in monetary liquidity. In other words, the Fed going back to massive rounds of QE and zero interest rates. If you go back to, and we can put that into more kind of finite numbers, if we strip out what happened from 2009 through 2022, really, because of all the Fed stimulus and all that, we get a much better picture of what markets kind of do over the long term. And so from 1900 to 2008, markets grew on average about 8%, which is exactly what you would expect given the economy grew at 6% and dividends on average averaged about 2%. So 6% plus 2% is basically 8% growth. And so the markets kind of grew in line with the economy. However, you see the problem then really from 2009 to 2022 because the market grew at 12% on average during that period. So not only was the economy growing at 2% and dividend yields were growing at 2%, you had the market growing at 4 percentage points above what the long-term average was from 1900 to 2008. And that's all that monetary liquidity. So Xing out that monetary liquidity, if we look forward over the next 10 to 20 years, returns on stocks should return to some level of economic growth, inflation, and dividends. So 2% economic growth is where we're headed back to. Inflation will be at 2%. Interest rates will be at 2% or less. And ultimately dividend yields will be at 2% or less. So do the math. 2 plus 2 is 4. 4 plus 2 is at inflation adjustment of 2%. That's 6%. So the best you're going to be looking at really over the next 20 years is probably a 6% rate of return. Now, here's the critical part about this. Throw in valuations, you're now looking at basically 0% because the market's already overpriced in that 6% growth rate over the next 10 years. So now you're at 0 based on valuations. That doesn't mean that your stocks are going to return 0 every year. What it means is you're going to have 10% one year, 10% one year. So now you're up 20%. Then you're going to lose 20% in the markets, and then you're going to grow at some level. And when you look over that 10-year period, you'll be exactly where you were when you started. Lance, that's never happened before in history. Well, from 1955 to 1970, it's exactly what happened. You actually lost 10% after inflation. 2000 to 2013, on a real basis, your return was absolutely 0. So yeah, you go through these very long periods in the markets where valuations and fundamentals matter dramatically. In the short term, 6 months, 12 months, 8 months, 15 months, 18 months, 24 months, fundamentals and valuations matter 0. It's all about market momentum, psychology, trend of asset prices, the rush to, the FOMO, the fear of missing out. So all that matters over a 1 to 2 year period is technical analysis. Fundamentals have nothing to do with the market at that point.
All right. So much there to dig into. So I'll make another comment, show another chart from Sven's that I think you're going to have a interesting reaction to. But if all that matters right now is, or in the short term, is technical, well, right, like I said, that seems to be all that's been mattering this year, right? So it's sort of like we have to assume it's going to continue up until the point that it doesn't, right? But when you talked about the market's potentially offering a projected return from here of zero, going forward for some period of time. One, that's, the argument that John Husband, has long been making with his charts. The guys from New Harbor, they bring up Husband's charts a lot. And I just want to clarify a point you made. So when you did the math there and you said, okay, the economy was growing at 6%, and then we had the 2% dividend yields, and then there was the 8% that matched the average 8% market return over that long arc of the past century, more or less. Now, post 2008, the markets have grown a lot more than the underlying components. That delta, which is, you said, was being made up by the Fed stimulus and intervention. Right. You can basically say that is basically pulling tomorrow's prosperity into today, right? So essentially, what they've done is they've taken returns that we would have experienced in future years, and they've pulled them earlier in along the timeline, meaning the further you go out the timeline, well, the piper eventually has to be paid, and you're going to have these years of underperformance because you pulled all that performance in advance, correct?
Well, correct. And so, look, at the end of the day, why do markets appreciate in price, right? So that's the question you have to answer. You say, okay, well, the reason that stock prices appreciate is because people are paying for a future value of cash flows and a future value of earnings. So if we take a look, and let's just take a look at 2008 through 2022 as an example. So from 2008, really kind of let's just call it 2009. So from 2009, we'll get through the Lehman crash. From 2009 to 2022, revenue, which is what happens at the top line of the income statement, has grown in cumulative total, right? So the total growth of earnings over that period is about a little over 100%. It's about 105%. So in other words, if I was earning $1 in 2009 as a company, today I'm earning $2. I've increased my revenue by 100%. The bottom line has grown by over 400%. So that's all the accounting manipulations. That's all the funny math that we use. Operating earnings versus real reported earnings to boost earnings and boost valuations. Stock buybacks have been a huge contributor to the fudging of the numbers. So now what earnings or what people are doing is they're paying up way more for inflated earnings based on all this accounting gimmickry. And you've got to start to look back at the basic point is at some point that math runs out. I can only buy back so many shares or eventually I'm private, right? So, right. I mean, there's only so many shares I can buy back. So all these accounting gimmicks and things that they're doing to boost earnings per share to justify valuations is all mostly accounting gimmicks. And those all have a finite nature. So at some point, the return of what happens, and again, to your point, we've been pulling forward all of this hope about the future. Is like, okay, I'm going to do this now, and hopefully on the other side of this, we're going to get much stronger economic growth. Consumers are going to start spending a bunch more money. My revenue will start to grow again at stronger rates to help support these valuations. The problem is we just never get there. The revenue growth hasn't really been increasing at a level to support the rate of earnings growth underneath. And all the accounting gimmickry and machinations, et cetera, is fine. There's nothing wrong with any of that. It's just you've got to be careful.
I would say there is, but go ahead.
Well, I'm just saying there's nothing illegal about it, right? It's fine what they do, but even the Wall Street Journal did a study and found out, they surveyed all these CFOs and roughly about 10% of earnings are all fudge. I mean, they all admitted it. It says, yeah, we fudge about 10% of our earnings numbers because we have to meet those numbers, because otherwise, if we don't meet the estimates from Wall Street, then we get pummeled in price. And so there's this kind of incestuous relationship between corporations and Wall Street to meet these estimates. And this is why we're always talking about the beat the estimate game every time we get into the end of a quarter. I was like, okay, well, how are we going to beat the estimates this time around? Of course, we lower the estimates. Wall Street lowers the estimates so companies can kind of hurdle over them, and everybody cheers that we've been beating estimates. But this is how, and again, this is why in the short term fundamentals don't really matter. It's all about psychology, right? Did I beat the estimates? Yes. Okay, buy the stock. But we don't really dig in to say, well, what really happened here with earnings? Are we really growing revenue? Well, we haven't grown revenue. There's companies out there that are trading at massive valuations that haven't grown revenue in 5 years, right? I mean, their earnings have improved a bit, but they're not growing revenue. They're a fully mature company, and we're paying very large valuations for those. And so at some point that will come home to roost, but in the short term, it doesn't matter. And you've got to remember, take everything else aside. Back in the 60s and 70s, we used to invest really long term. The average holding period was 6 to 8 years for a stock. So fundamentals value, really meant a lot back in the 60s and 70s and 80s when we were buying stocks, because we were buying stocks with very long outlooks. And so if we're buying something and we're going to hold it for 6, 7, 8 years, I better make sure that earnings growth is there to support my outlook for that long-term period. Today, the average holding period is less than 6 months. So earnings and growth and fundamentals, if your holding period is less than 6 months, none of that matters. It's all about market momentum, psychology, kind of Wall Street views. And because again, we trade on earnings estimates. Earning estimates going up, and boy, look at Nvidia. We better buy that because earnings estimates are going up. I'm just using it as an example, but that's all that matters in the short term. So all this fundamental talk is great, fine, dandy. The economy's doing this, and this sucks over here, and that's great over there. None of it really matters for the stock market, except in the short term. It's all about price momentum and psychology, because that's what drives the market short term.
It's a great point. It's like a game of hot potato, right? Whereas, like, as long as you can hand it off before it cools, that's somebody else's problem to figure out, right?
It's the greater fool theory.
Yeah, and I was going to mention Nvidia, but I think Nvidia is a poster child of what you're talking about right now, where any way you look at the valuation right now, it's priced for, I was going to say perfection, but I think it might be for better than perfection, right? And there is a potential universe where Nvidia meets, all the expectations that are placed on its stock price right now. But as you've said, competitors are going to be coming into this market, at some point, and we see this happen again and again, right? Where just expectations keep getting ramped up to the point where the stock is the wonder stock until at some point there's that disappointing quarter where people realize, oh my gosh, you know what? Yeah, we really got a little ahead of our skis here in terms of what's possible for this company. And then you have these big, massive, price adjustments, right?
And just one last statement on this, and then you can't set aside the whole passive indexing effect that we've talked about so many times either.
Right, the giant mindless robot of an increasing percentage of every dollar that goes into the market goes into just a few stocks, which power the indices higher. As you were talking, I was thinking about kind of this collusion between corporate America and Wall Street's to kind of keep this great game of wink wink nod nod deception going on. I was talking to somebody recently, sort of reflecting on the Tour de France, and in particular the Lance Armstrong era, right, where I actually know a guy who rode on Team Postal and was involved in all of that, and it's a really interesting conversation, probably more than we have time to really dig into here, but there was massive collusion, right? Massive collusion of the team owners, the team doctors, all the racers, right, to be engaged in the doping and stuff like that to keep the game exciting, right, and to keep a champion like Lance, that story going because everybody loved it, right? And even the race, the Tour de France people who ran the race, who were in charge of the regulators who had to inspect the riders to make sure that they weren't doping or whatever, they were clearly in on it, and they didn't want to expose what was going on because they didn't want to ruin the gravy train of all the ratings and sponsorships and everything like that. So, there'd be things like if they were going to come test you, they would tell you, and they would give these guys, and oftentimes, several days warning notice or whatever, so that they could, clean their systems out and, do the flushing and everything like that so that they could pass the test, right? It was something that everybody just sort of said, oh yes, of course we police, the integrity of the sport, but wink, wink, nod, nod, we know you're going to do that and we're going to look the other way, right? it's very much kind of got that kind of feel here, which of course can last for a long time. I mean, how many championships did Armstrong win? 7 or whatever.
Right.
And this stuff didn't even come out until after he retired.
Right. You know, and when we look at that, you go, well, why would they do that? Right. It all comes down to the money.
Yeah, it was a gravy train.
It was because Lance Armstrong attracted viewers. The television networks, you know, Lance Armstrong's riding it. I mean, I watched Lance Armstrong ride, and I don't even know that much about biking, but I would watch the Tour de France to watch him ride because he's my namesake. But you know, the point is that when you have, and look, you know, we can go through every major sport, right? You know, you go through baseball, you go through football, you go through all these other things, and we've caught people in baseball, you know, using steroids or corking bats, you know, whatever it is, because they attract viewers. They put people in seats, and you can't discount. My point is, you can't discount the fact of what money drives. And this goes the same way with Wall Street and companies. You know, I've done articles on our website talking about where do you, right, the average person, fall into the importance of Wall Street? Where is the consideration for you? You're at the very bottom.
Where's the bottom rung of the ladder, and then what's below that?
Yeah, exactly. I mean, you're way down there. What comes first? It's you know, corporate profits. It's, you know, it's investment banking. It's, you know, the important relationships with their pension funds and their managers. What matters to analysts? Is it really, you know, if you look at analyst estimates, they are wrong all the time. Like, analysts are never right, ever right. And, you know, but nobody cares about that, because the reason that analysts always rate a company, and this is why, you know, there's no sell ratings on companies. Every analyst rates a company a buy. At worst, they'll rate them a hold. And the reason is if I'm going out for investment banking and I want to get your secondary offering, which makes me millions of dollars as a company, and I've got a sell rating on your company, you're probably not going to want to do business with me. So, right, you know, this is all a very incestuous relationship that all revolves around money. And, you know, this is the one thing as an investor you've got to understand, is that you can sit home and you know, sit on the sidelines and it's like, I know this market's going to crash, look at the economy or whatever. And yeah, maybe, but there's a huge incentive to keep this game going by Wall Street. And that's where all the money is. The money that drives the market is not retail investors. You've got your influence in the market is at the bottom rung and maybe a little bit lower. It's all about institutions, pension funds, hedge funds, and all these guys have a very, very close incestuous relationship to keep the game going because it makes them money.
All right. And so, look, we're not trying to depress people, although it can be a little depressing.
You got to understand the truth, right?
Well, you got to understand the game that you're in. Exactly. Yeah. Right. If you're going to swim in these waters, you got to understand that there are whales and sharks and whatever. And, you know, you're probably a guppy. So you just got to learn how to navigate as a guppy. Yeah. All right. So Sven made so again, I don't know if you had a chance to watch that video with Sven, Lance, but you should, because I think you would agree with a lot of it. Because a lot of the same, you know, his overarching point is sort of the same as the drum that you've been beating this year, which is, yes, there are lots and lots of macro reasons to be very pessimistic this market and be worried about a major correction or whatnot. But that doesn't mean it's necessarily going to happen tomorrow. In the way that the game is played, you know, they can push reality off for a long, long time, right? And so that's allowed you to, you know, not be caught on the sidelines this year, right? So you've been able to participate in the run up here for your clients. You know, you've said, hey, you wish you'd gotten back in a little bit earlier and a little bit bigger in some of the names like Nvidia, but still, you know, there's a lot of people that totally went to the sidelines, you know, back at the end of last year, understandably, because it looked like we were about to fall into a recession and everything looked terrible, and they've missed out this entire rally, right? And of course, that's the risk of perhaps being, you know, 100% in on a given thesis, right? You want to have some diversification to make sure that if your primary thesis doesn't play out, you've got some hedges in place, right? But anyways, you have also cautioned bears, you know, people not to be too bearish, and you've had a number of reasons for doing that. But Sven, who you know, I think is kind of bearish by nature, but at the same time, he realizes you got to be long something to make money, right? He brought up this great chart just as sort of like a sanity check for bears. And this chart shows The major corrections and the major rallies in the S&P over the past, I don't know, 15 years or so. No, not 15 years. Sorry, past 6 years.
Yeah.
And basically, you look at this and you say, okay, wow, like the bearish corrections in the market are short. they are quick. Like if you're going to make money on the bear side, like you don't have a lot of time to do that, right? And the bullish periods are much longer, right? So like the system supports the bulls, at least the system's the way that it runs. It's a lot easier to make money as a bull because you can jump in one of those longer rallies and just kind of ride it, right?
Yep.
Whereas if you want to position yourself bearishly, you got to get your timing really, really right, because they don't happen all that often, but when they do, they're just over really, really quick, right?
Well, look, bear markets historically, going back to 1900s, are fairly short in nature. Look, and let's just let's be a little bit more loose about the definition. And if you look at 2022, peak of 2022 through the end of October, let's make that one big red box, right? I could have shorted in January 2022, and in October, I'm feeling really good about my short position, right? Recession's coming, everything looks terrible, the Fed's hiking rates. And then now my short is almost underwater again. And so, this is the nature of bear markets in general. They tend to be very short-lived. 12 to 18 months is about the longest of most bear markets on record. And I'm talking about real bear markets. And this goes back to what you and I have talked about previously. Not one of those things on there that you're looking at is a bear market. And, right. and to Sven's point, these are corrections within a bullish trend. And this is the huge differential between a bear market and a correction. Corrections are extremely short-term in nature. They are fast, they are swift, and then the market quickly recovers back to all-time highs. And so what you notice is that most of these so far, and again, when this market gets back to all-time highs, at some point, we'll look back and say, well, the bullish trend was never broken. If you draw a line across the bottom of that entire chart, you'll see that the bullish trend never broke. The market never reverted from rising prices to falling prices. We simply just got very extended in 2021 because of all that money we injected into the system. In 2022, we just returned back to the bullish trend. That's all that happened. There's been nothing hugely negative about this market really since 2009. And so to his point and to his credit, he's absolutely right. It's been very tough to be a bear since 2009 because every correction we've had has been very short-lived. By the time you realize you're wrong, you're underwater, and it's just been easier to be long, right? And just kind of ride it out.
Right. And so that was sort of his point here, which is, not don't be bearish, but if you are, again, just be aware of the conditions that have to play out for you to be right. And as long as we're still in a bullish uptrend, the way that you're talking about on a secular basis, yeah, if you start making some money, you got to ask yourself real quick, on the bear side, okay, do I need to lock in my gains here now or not? Because these tend to be pretty darn short, right? So look, I'm not telling folks not to be bearish, and I'm certainly not telling folks not to be conservative here. I think we should actually, definitely be conservative, given these macro concerns that at some point, should matter. But don't be overly bearish in the way that you have been counseling folks not to be, Lance, because while we're still in this bullish uptrend here, that's just sort of the way the game plays out.
And look, we're very conservative as investors, right? I mean, we measure our risk, we monitor our risk, we rebalance our portfolio to adjust for what we see as risk in the markets. So don't think for a moment that we're just saying, hey, don't be conservative with your money. But there's a huge difference between being conservative and being out of the market, right? You can be conservative and be fully invested in stocks in the market. That is completely doable. You're just not going to own 7 stocks. So just talking about a portfolio, let's say that you're very conservative by nature. You don't want to risk a bunch of money. That's fine. You can still have 100% equity in the market. That's fine. You're not going to own 7 stocks. That would be hugely aggressive and hugely risky. But I can balance my portfolio across sectors of the market, across stocks in the market, because there's a lot of companies out there that simply trade very cautiously, very conservatively. They don't go up a lot. They don't go down a lot. They kick off a dividend. And during times of market stress, they're not going to hurt you. They're basically kind of a bond in equity disguise. So that's certainly very easy to do. But we often confuse this idea of, oh, if I'm in stocks, I've got all this risk, so I'm going to be conservative, so I'm going to be all in cash. And then the market takes off, and you're like, well, now I'm all in cash. I've got to get back in the market. Of course, now you're buying the market probably at a peak, because by the time you realize that you've missed the boat, the market's already made its move. So you buy at the top, then you wind up losing money, so you get all back out again. And this is why the average investor over time vastly underperforms the markets, because they buy high, they sell low, they do exactly the opposite of what you need to be doing.
All right. So look, got to move on from here.
Sure. That's all. We could do a whole show on this.
We totally could. But folks, again, I highly recommend watching that video with Sven. All right. Well, look, just sticking on markets for a moment. So bond yields, U.S. Treasury yields remain elevated here at this point in time. We were talking a little bit about this before we started recording, Lance, but the 10 years, I think, back in the 4.2% or so range as we're talking here. So anything notable about yields right now in terms of as stocks are struggling to find their feet here?
No, not at all. I mean, yields really haven't done much of anything. We just kind of keep trading back and forth, and we're trading in a range that, and again, kind of, if you look at kind of where we are economically at the moment, we're still kicking off about 4.5% economic growth. We're going to, the Atlanta Fed right now is projecting roughly about a 5% growth rate nominal for the third quarter. So if the economy is growing at 4 to 5%, inflation's running at 3.3%-ish. So 4.25% rate on the 10-year Treasury is about right where it should be, give or take a little bit. So, as economic growth continues to slow, as inflation continues to decline, then interest rates are ultimately going to start to trade in a range relative to economic growth and inflation, because interest rate function of economic growth and inflation. That is what drives the yield. If I'm loaning Adam money and I go, okay, I'm going to give Adam money for 10 years, I have to compensate for what economic growth is going to be, opportunity costs. Basically, could I invest in something else at, if the economy is growing at 3, but I think it's going to 6, I need to charge Adam more because I've got opportunity loss that's going to occur over a 10-year period as the economy continues to get stronger. If inflation's running, I've got to adjust for my lending rate so that the money I have on an inflation adjusted basis gives me my rate of return. Of course, I got to compensate for his risk of repayment, but with government treasuries example, there's no risk of repayment, so there's no adjustment for that. So I've got to factor all these things in. That's what generates that yield or that coupon, on these bonds. And so that's why there's always historically a very high correlation between interest rates, economic growth, and inflation. And so as those things continue to slow, and they will, interest rates will start to come down. But right now, interest rates are about right where they should be.
Okay. I should note too, just before fully moving on from some of the commonalities between your outlook and Sven's, I did sort of ask him to look forward and share his trajectory of how he thinks the markets are going to play out from here. Yep. And he basically said, look, until we see some breakages of some of these key technical levels, right? So like as you've said, even the correction that we just had, we didn't take out the longer moving averages, right? Yeah. We didn't get anywhere close to the 200 DMA, that type of stuff, right? So he said, as long as this market's sort of still following the TA, he thinks it's going to go higher from here for some period of time. How long, he doesn't know, right?
Right.
But he does think that something will break. That interest rates this high, cost of debt this high for the government, for corporations, for households, is going to break something. The Fed is going to have to intervene. So basically, the fundamentals are going to matter at some point, right?
Absolutely.
And so he expects that there will then be a pretty sharp market correction, in that process, to be followed by, dramatic central bank rescue efforts that will then probably eventually reinflate things and resurge the markets again. Very similar to you and many of the people that are on this channel. So he's not saying it's going to be bullish forever,
Right.
He's basically just saying, like, we have to keep our eyes on the door, knowing that at some point a fire is going to break out in the dance hall here, but music's still playing.
Yeah.
Right now nobody sees any flames or smells any smoke. Right.
Well, that's why I said, technical analysis is great for 6 to 9 months, 12 months, because it just is a reflection of market psychology. Just remember that the market is a big giant organism, right? And so it's a living, breathing thing that is comprised of two types of people. You have buyers and sellers. And that's why it's called a market, right? Because every day, every moment, every second of the trading day, there's a bunch of people over here thinking they're smart by buying something, and there's the same number of people over here selling stuff thinking they're smart. But it's all about psychology in the short term. And so that's why technical analysis really in the short term is all that matters. Yes, we analyze fundamentals. We own companies that fundamentally are very cheap, and we know that long term we're going to get paid handsomely for owning those stocks. But we also have a portion of the portfolio that's dedicated to momentum and psychology and what's happening in the markets, because that's what generates returns in the short term, while we're waiting for those longer term fundamentals to ultimately matter. And Sven is absolutely right, is that in the next 6, 12, 18, 24 months, the higher cost of debt is going to be problematic. I wrote about this in last weekend's newsletter. There's a tremendous debt wall coming up over the next couple of years. Refinancing is going to be problematic. Tighter financial conditions across the board. We're now reaching some levels on financial conditions that have always preceded recessions. Now, real quick, I got an email on this last week, and I just want to clarify something. When we're talking about financial conditions, we are talking about economic financial conditions. There is another financial conditions index that gets circulated around the market a whole bunch. It says, look how easy financial conditions are. That is all market-based. It is debt yield spreads. It is the market and some other factors that are comprised that. Yes, that indicator shows a very loose financial condition in the market because nobody's worried about risk, right? Yields are very compressed right now because nobody's worried about a blowout in high yield. Yet, when that begins to occur, that financial condition index will catch up with everything else, because that will always kind of be the opposite side of the story, because as real financial conditions start to loosen, that will be tightening at the same time. And that'll be because the Fed's stepping in to bail out things, something's broken, you've had a recession, whatever it is. But it's always important to understand what the drivers are of financial conditions. And when we look at the economic financial conditions, interest rates, the dollar, the Fed funds rate, et cetera, those are very restrictive and at levels. And I've built some composites that I've been producing lately on our website and on Twitter, showing that these are very, very restrictive levels, and they have always preceded a recession when you're at these levels. And that's just simply because we have so much debt in the economy. High interest rates are going to cause a constriction in consumption at some point down the road. It's just a question of when we get there. And when you do that, then earnings are going to decline, and market prices and valuations will have to readjust to compensate for that. So yes, fundamentals will matter at some point, but that's why we allow the technicals to tell us when to start making that more movement back towards cash and other areas.
Okay.
Real quick, one more statement. And this is the best indicator, right? Sell the last Fed rate hike. If you go back through history, every time the Fed stops hiking rates, you're within 6 to 9 months of an economic recession. So there's kind of an axiom in the market. You sell the last Fed rate hike, and you buy the last Fed rate cut.
Okay. Now, of course, the Fed's never going to tell you for certain this was our last hike, right? So yeah, you're gonna take some guesstimate in there, but yeah.
yeah. But you'll know, because they'll stop. But we'll go, we'll go, 3, 4, 5 meetings where they don't hike rates. But again, you don't have to worry about that. Just wait until they say, hey, we're going to cut rates.
Yep.
And then when they get to zero, start buying with both hands, because once they get to zero, they can't cut anymore. So.
It's so funny you talk about this indicator that has just always double extra been correlated with the recessions, and I get it that people today are just kind of like yawn, right? Like, I mean, okay, let's add that to the list, right? That hasn't mattered all year, right?
And just because it hasn't mattered in a year doesn't mean it won't. And again, we talked about
I know you and I talk about it all the time.
Yeah,
my arm is
last year,
sore from beating that drum.
yeah. Everybody last year was, oh, a recession's coming, a recession's coming. And I was telling you then, it's like, hey, we're probably not going to have a recession until the end of 24 because, everybody's expecting a recession, and Bob Farrell, when everybody expects something to happen, something else tends to occur. Now, nobody expects a recession. That's actually great. But importantly, it's always about, interest rates and Fed rate hikes and those type of things. And we are just now entering that 6 to 9 to 12 month period to where the clock is now ticking for that next recession. So we're in September, add 9 to 12 months, next September, next, October, November, December, we're probably going to, you and I will probably be sitting here talking about, economic growth and risk of recession.
All right. So it seems like you and Sven and so many other people, think that general arc that I described a few minutes ago is what's going to play out, right?
Yeah.
And
timing is always a problem.
Part of that arc, right, involves debt spreads blowing out, right? So you said, you just said, look, nobody's worried about risk, right? Credit spreads still super tight, right? So to me, that kind of seems like, I don't always say the word sure bet. There are no sure bets, but it seems like a highly confident gamble or a highly confident bet that at some point they're going to blow out, right? And we don't know if it's going to be tomorrow or if it's going to be in 9 months or whatever, right?
Yep.
I mean, does it make sense while in theory they're super tight and therefore, something like a leap on them would be super cheap, that you'd want to start at least dollar cost averaging into some instrument that's going to benefit when those spreads start blowing out, if you feel like that is sort of an essential step on the way to this arc unfolding?
It's kind of going back to trying to short the market here. So here's the problem that you've really had since really about 2018. It took about from 2009 to 2018. We had the government the Fed kept stepping in and bailing stuff out. And everybody was like, okay, well, yeah, they're bailing out this time, but it's not going to work next time. And then after the third time, everybody's like, okay, well, they're just going to do this every time. And so, kind of like training Pavlov's dogs, we've now taught everybody that if anything happens, the Fed's going to run in and bail stuff out. I mean, 2020 was a great example, right? They actually bailed out junk bonds in 2020, right? And they were buying junk bond ETFs, which totally against their ability to do, but they manufactured that through BlackRock. But the whole rant for another show. But the thing is again, markets are about psychology, and right now everybody's bailing into high yields. Like, oh, I can buy this high yield bond and I can get more than the treasury, and this is so I'm making more money, under the belief that no matter what happens, the Fed's going to bail that out, right? So if Boeing goes bankrupt, or if General Electric went bankrupt, pick a company, I'm not picking on them, I'm just throwing out names. Apple was going to go bankrupt, that the government's going to step in and go, well, that's a systemically important company. We can't let Boeing go under because, we're a manufacturing economy. It's complete, mind you, right? To say that companies are so important, we can't, I know you're going to bleep that out, but the companies are so important that we can't let them fail is complete nonsense. This is the reason that we have bankruptcy laws in the country. But we have decided as a country to bail out all these companies. We don't want to allow anybody to go into bankruptcy because that would just be terrible. People would lose their jobs. And again, it's just nonsense. But this is all about politics at the end of the day, and getting reelected and keeping the money in that and moving in the right directions. So we've ignored our rule of law, and we've ignored our processes for dealing with these situations that would have allowed some of this excess to get pulled out of the market. And we talk about forest fires are healthy for the markets. Forest fires are healthy for the forest, but recessions and bankruptcies are actually healthy for the market. It gets out the weak players. It provides opportunity for new players to come in and take advantage of a space that gets opened up. And we build better, stronger, healthier companies and better, stronger, healthier economies. But we don't want to do that because we don't want the pain short term, right? We don't want that. So now we've trained all these investors that I can take on an unlimited amount of risk because I know the Fed's going to bail me out. So we may not see that big blowout of spreads that we've seen historically. I'm not saying that's the case, absolutely, but I'm just saying there's a potential And if you try to make a bet on credit spreads blowing out at some point, that you might not get paid for that because the Fed steps in and suppresses the blowout to keep it from rolling into the rest of the economy and the financial system. I'm not saying that's absolutely the case. I'm just saying that's, to your thesis, while right, doesn't mean now that it'll necessarily happen. So it's
that's true. I mean, you could say that for any bearish bet, right? Which is just, hey, Papa Fed's going to come in and just always make it right, right?
Right. Look,
now, of course, they didn't in 2022, but yeah.
Yeah. But look, but nothing really melted down in 2022. I mean,
no, you're right. I mean, that's what they wanted to see, right? They wanted to see some correction that didn't involve a rescue, didn't need to have a rescue.
Yeah. And look, all your major companies went down a little bit, but not a lot. I mean, you look underneath the surface in the small and mid caps, the Roku,
they got crushed. Yeah.
Yeah. The ARK investments, and those things got completely decimated. But those are such a small impact on the financial markets and really the overall economy that the Fed's like, whatever. As long as Apple, Microsoft, Google, those guys don't go down with the ship, we're okay, right? Because
sorry to interrupt, but
yeah,
we in the capitalist West, right? We talk about the evils of the communist regimes where everything is state owned, and you think of a company like Russia. I remember in my very early days in investment banking, I was involved in a lot of international privatizations. And, they just have these massive state-owned companies that, it's the one company that's responsible for all the electricity in the country, right? Or, all the water, all the oil, whatever, right? And we talk about, kind of how that's so sclerotic, right? There's no competition. You just have one big, entity that owns the whole space, right? It's almost like I know we talk about how we don't have true capitalism anymore. We've got corporatism, but it just increasingly feels like the same way, right? Where we've let these cartels emerge, but now they're protected by the government, right? So basically what you're saying is look, the Fed doesn't really care about all the other companies. It doesn't care about the S&P 495, but it sure cares about the S&P 5 because there's so much a percentage of the market value out there and so much of a percentage of what's driving the economy that they're going to do whatever it takes to keep those guys going. It's basically just like a carbon copy of the communist model in some ways.
It is. And we're paying a consequence for that too. We see this in the kind of the dysfunction of the markets. We see it in the dysfunction of the economy. We see it in the spread of wealth between the haves and the have-nots, and we talk about these problems that long term are going to be very economically damaging, for the younger crowd that's coming out. Thank God I'm old and I'm going to die soon, so it won't affect me. But for the Gen Zs coming up, they're going to pay the price for this, and they don't realize it yet, but it's coming. And the debt matters. The debt matters a lot. And, and I keep, I'll probably bring this up every week on the show, is that if you just want a good, kind of, microcosm of where we're headed, just go take a look at Japan, right? They're 30 years ahead of us, but where they are is exactly where we're headed. And unfortunately and I saw an interesting tidbit this morning I think it was on TikTok or somewhere, but it was a post by a very young person. It's like, when you mean to tell me that I'm gonna have to work a 9-to-5 job for the rest of my life, right? This is what I'm gonna be doing every day for the rest of my life, is coming to this job and having to work until 5 o'clock at night and then go home. Who signed up for this? Was his last kind of point. What is is this what life is supposed to be like? And this is the realization that eventually that group has got to come to, is that we're in a transitional time within the economy to where, the boom times that we had back in the 60s and the 70s, when we were producing and manufacturing and building and constructing and looking ahead, you go back to the state fairs in the 70s, where you had all the exhibits of the future tomorrow, and we were visionaries back then. We looked forward. We were looking at going to the stars and exploring space and innovating and growing and doing all these things. And now we spend all day with our faces and computers, kind of regurgitating data all day long, guilty as charged. And so we've moved into the service society, which is an immediate gratification society and not a building society. And we're paying, and that has to, a service society has to be supported by debt, because you have slower rates of economic growth. And of course, the more debt you have, the slower growth you have. And it's just a very vicious cycle that leads to more and more income inequalities across economies. And that's just something that eventually we're going to have to face. And unfortunately, it's kind of like being, getting overweight. You didn't get overweight overnight. You're not going to get skinny overnight. You're going to have to go through the whole process of diet and exercise. And I know it sucks and it's painful and it's terrible, but you eventually get back, to being in shape, and life is better. You feel better. You look better. Life generally just is better, when you're healthy. But you're not going to get there overnight. And we keep looking for the quick fix, right? We want to try, it's like, oh, if we just do A, B, or C, if we just do MMT, we're going to be fine. This will fix everything overnight. We'll be able to pay for everything. And that doesn't work. And it's just going to have to be a realization when we get there.
Yeah, well, I mean, what you're describing, right, is sort of the cleansing element of the fourth turning, right, which is the pain and the cleansing, right? It's where the status quo falls apart and something different and hopefully better replaces it, and then you start a new growth cycle. And we've talked about that a lot, especially in the wake of the recent interview I did with demographer Neil Howe. And folks, you should watch that if you haven't yet. All right, but
we had the depression. We went through the depression and went through a cleansing, and so it's just about time to do that again, unfortunately.
Yeah, and I've talked about this a lot with many folks in this channel, so we won't go into the weeds of it. But we have a monetary system that basically doesn't have a limit on how much money can be created, right? And this is not unique to America, right? It's now the majority of the major world nations out there, really almost all of them at this point. And to create money, it's actually created through debt, the issuance of debt, right? And so we have this kind of end game baked into our monetary regime here, right? Which you just get to a point where you just have too much unserviceable debt that the system just doesn't work anymore. And what's crazy is we're just trying to your point, always finding the next quick fix that'll let us just kick the can a little bit further down the road. But nobody is asking the question of, okay, but like at some point, there's just mathematically a point at which we can't do that anymore and the whole thing collapses, but nobody wants to actually admit that or deal with it, right? It's someone else's problem, hopefully in the future. Well,
yeah. And that's why, I said, hey, I'm going to run for president. And, my platform is simple. First thing I'm going to do is I'm going to cut government by about 2/3. I'm going to return most of the departments back to the state. All I'm going to be responsible for in Washington is just national infrastructure and defense. Outside of that, everything else belongs to the state. Education, oil and gas production, energy, everything. That goes back to the states. Let them deal with it. Then once I've slashed the budgets and cut spending in Washington, then I'm going to come to the American people and go, okay, here's what we're going to do. Now it's your turn, right? And here's the sacrifices you're going to have to make. We're going to have to deal with Social Security. We've got to deal with Medicare. We've got to deal with all these type of things. We can't do a lot of the stuff that you want to do, in terms of just funding anything and everything. That's just not sustainable or usable. And we're going to have to go through this period. Of course, that's going to lead to a very depressive state in the economy for about 2 or 3 years. But coming out on the other side of that, we're going to be much healthier and be able to grow much stronger. But nobody wants to deal with that 2 or 3 year pain to get there. And this was my argument about the financial crisis. Should have never bailed out the banks. We would have had a much healthier banking system coming out in 2009, 10, because we wouldn't have had, 5 banks making up 40% of the banking industry. Now they make up 60% of the banking industry. We would have had a much more diversified financial industry. We would reduce risk across the board, but it would have been very painful. And a lot of people would have lost jobs, and it would have been terrible. People would have lost their homes. But the people who lost homes would have been able to relocate to areas where there were jobs instead of locking them in.
We'd be 10 years into the boom by now if we had done that, right?
Absolutely. But again, it's always about the avoidance of the short-term pain. We, as Americans, have gotten very complacent, and we don't want to deal with the short-term pain to fix things. And this is why things keep getting worse, because we keep coming in with all kinds of new programs about how to fix something without actually fixing it. And we're just going to paper over it. And that goes from healthcare to finance to Wall Street. I mean, you just right down the road, instead of doing what it takes to fix these problems, and make things better, more affordable, and more usable, and letting capitalism actually grow and flourish and work as it's supposed to. Because capitalism is very brutal. It's very Darwinistic, right? The strong survive, the weak perish. That's exactly how capitalism is supposed to work. And you have better growth out of that over time and better economic prosperity for everyone in the economy, not just the few.
No, and we've talked about this in the past, and we've got way more stuff to get through to get too distracted on this rant. But like,
I'm not ranting. I'm just saying this is why nobody will vote for me. I keep running for president. Nobody votes for me.
Well, I'm going to vote for you, but I definitely will encourage you to move the Oval Office up into space, because you're going to have a big target on your head as you force the country to go through these lean years. But we are not the greatest generation, right? We just don't have the spine, the fortitude, the constitution of the society that clawed their way out of the Depression and fought both world wars and all that stuff. And we have really developed a cultural aspiration to feeling no pain, right? To being helicoptered and guaranteed a safe space and free of all aggressions, macro or micro, right? And that's the antithesis of what we need to go through what you're talking about, right? So, all right. I also realized when I made that all this messaging is vastly more important for Gen Z, right? Because that's the generation and the ones below that are really going to have to come up with this long-term solutions to this. They're going to feel the brunt of the pain as us older folks die off over the next couple of decades, right? But I realized as I made that comment about carbon being a carbon copy, it's like, yeah, that's right. Any younger people listening to this probably actually have never seen carbon paper. They probably don't get that analogy, right?
Exactly.
Yeah. All right. Well, look, you made a comment earlier, and forgetting what it was, but it was a good segue to this next topic, which is you wanted to share, I think, a chart that a viewer had sent your way, but basically explaining that while we have the Fed, as I've talked about, we've got the Fed jamming on the monetary brakes, but we've got the fiscal side of the equation hitting the gas with all the deficit spending we're doing. You're saying actually the Fed may not just be hitting the brakes; they may actually be doing some stealth QE. So, can you elaborate on that?
Yeah. So it's interesting. Just as we talk about that, it's like, oh, the Fed's doing QT, and they are, right. So they are reducing their balance sheet by $60 to $90 billion a month, and that's a very true statement. But there is kind of an interesting byproduct of that, or kind of an interesting backdrop to that as well, because this has been one of the arguments for why interest rates are going to go to the moon, because the Fed's selling treasuries now that they're in QT, and that's not really the case. And again, we've talked about this a lot on the show, and we've talked about kind of our bond positioning and why we're positioned in a certain way in our bond portfolio, and what we're expecting to come down the pike here very shortly. Hold on, and while I'm talking, I'm just getting this chart put together. So what this chart is, and again, this is, I wish I had the viewer's name, and I apologize that I don't. But if this is your chart, thank you very much. It was really well done. But what this is this is a breakdown of the Fed's balance sheet by maturity. So you have bonds that are maturing in 15 days, bond maturing in 16 to 90 days, 90 to a year, 1 to 5 years, 5 to 10 years, and over 10 years. What's important here is, and we talked about this before, the Fed is doing QT. So people have assumed that the Fed is selling treasuries, and they aren't really selling treasuries unless they need to. And when they're selling treasuries, they're selling only fractional bits here and there. Mostly what they're doing is that over really since 2012, 13, 14, 15, 16, 17, 18, all those years, of doing QE, they were buying a lot of shorter duration treasuries, and they were buying things that were maturing, and they were buying 10-year treasuries, but these 10-year treasuries might have only had 5 years to maturity or 7 years to maturity at the time. And so fast forward 5, 6, 7, 8, 9 years, a lot of these bonds are now maturing. And so the Federal Reserve is going, okay, I've got these bonds that are maturing. I've got 60, and just use some easy math here just for everybody. Let's say I want to reduce my balance sheet by $50 billion this month, but I have $70 billion worth of bonds that are maturing. And so I've actually got to go in and buy $20 billion worth of bonds. Now, when you look at this chart, look at the orange line. Since 2018, that orange line has really been in, sorry, I said 2018, I apologize. Since 2019, early 2020, when we started kind of going through all of our problems, the Fed's actually been buying long dated treasuries. That orange line has been rising as the other bonds are maturing and you're getting this roll off. So as these bonds are rolling off, they may be having, they are reducing their balance sheet. If you look at QT, you say, well, Lance, the balance sheet's coming down. It is, but they're just letting a lot of these shorter duration bonds mature, and they're buying the gap that they need to keep that runoff rate at 60 billion. So if they have 100 billion coming due, they may have to step in and buy, 20 or 30 billion in a month to keep that runoff rate at 60 billion. And so you can just kind of see this is a percentage of the total maturities. And if you look at the purple line, which has been your biggest decline, that is bonds maturing over 1 to 5 years. That's where the QT is happening. And then underneath the surface, they're buying long duration bonds, the 10-year bonds that are maturing in over 10 years. That's what they've been buying and shifting the balance sheet into.
So let me ask a couple questions about this. I don't know if we actually know for sure, but are they necessarily buying the 10-year and more, or is it just as the shorter dated instruments roll off, the percentage of the portfolio that remains is increasing, right?
That's part of it. That's also part of it. But you should also start seeing, if that was the case, you'd have if they weren't doing some buying, and again, I'm not saying they're just buying hand over fist, don't get me wrong. I'm just saying is that when they have more maturities coming due than their 60 to 90 billion a month, whatever it is they're wanting to tighten, they're having to buy the differential. So if you got 100 billion coming due, I've got to buy an extra 10 billion, right? But if it was simply a function that it was just the decline in the 1 to 5 years, you would also be seeing big declines in some of the shorter duration treasuries, which they're also buying. But those aren't declining at a clip. So part of it is, yes, just the rebalancing of the overall balance sheet, because you do have a roll off, shorter versus longer, but they're also having to buy to make up the difference. But the point that really you want to make here is that there's been a lot of talk about, oh, well, the interest rates are going to go up, kind of ad nauseum here because the Fed's just selling long dated treasuries, and they're really not.
Okay, so
it's more of a maturity game than a selling game.
Yeah, so I guess we would assume that the 10-year would be at a higher yield right now if this were not going on.
Probably.
Right? So we've had some people out there, we talked a little bit about this the other week where, everybody was like, oh, Fed's going to pivot for, a year and a half. And boy, rates are going to come down as soon as that happens, right? To all of a sudden, oh my God, rates are just going to keep going up now and the world's ending because, bond yields are going to the moon. And nobody wants to buy treasuries anymore. And Janet Yellen just announced that she's going to release another 1.9 trillion in the second half of this year. So it could be what part of the Fed is doing there is just trying to mop up the excess supply in treasuries so that yields don't get too big.
Right. Well, also too, here, let me share this chart one more time. And because again, when we talk, and to your point about where yields are, so again, we had this decline initially. So this is the second quarter of 2020, right? So here's the pandemic sell-off. Okay. So to your point about inflation and interest rates and going back, so if the Fed wasn't buying these longer dated treasuries, what should the interest rate be when inflation in 2021 and 2022 was running at 9%? Right? It shouldn't be 4 for sure, right? Because if inflation's running at 8, 6, 7, 8, 9%, the interest rate on the 10-year treasury should align more closely with what was economic growth doing. We're growing at 12% economically. Interest rates should have been shooting off to the moon. We should have been at 6, 7, 8% interest rates, not barely clipping 4. So there was a lot of buying in here to keep that longer end of the duration of interest rates down as well, because the Fed has to know, just like everybody else does, if interest rates on 10-year treasury went to 7, 8, 9%, we would have been in a really massive recession pretty quickly.
Okay. So basically what you're saying is the Fed is engaged in QT along with its rate hikes, trying to cool the economy, but it is trying to prevent something from breaking by doing what it can to keep the longer end of the yield curve contained.
Yeah, and look, that's just that's what the data tells me. I don't know. I am not in communication with the Federal Reserve. I'm not looking at their buying and selling every day. But when I look at what interest rates are doing, and then you look at this breakdown of what's rising in the balance sheet, what's falling, it certainly adds some credence to the theory about why interest rates aren't shooting off to the moon when everybody thought they were going to.
Okay. And I guess it gives us some confidence that, man, if the Fed is even continuing to buy as it does QT, that if it takes the chains off and decides it really wants to get into rescue mode, it can just buy out the wazoo because it's even buying when it's technically selling. Okay. So let's move on to another series of charts that you put out recently. You just came out with a piece that I thought was really interesting about the importance of the difference between GDP and GDI and how those are very diverged right now. But that divergence probably isn't going to last forever. And that divergence is telling us an important story.
Yeah. So, this is, part of, a lot of things that we kind of continue to talk about. So, again, let's just revisit our conversation a little bit earlier, talking about, hey, the market's technically bullish and, it's all those other things. I'm bearish by nature. I mean, that's just my nature. I'm very conservative. So I guess that puts me in the bearish camp because I'm always kind of looking out for what the next shoe is going to fall. So one of the hardest things for me to do is be bullish on the market. And
so basically you're an eagle, but instead of feathers, you've got fur and you've got claws at the end of your wings.
Bingo. That's I guess that's the best way to put it. But that's why, look, I've published a lot of articles lately. Is a recession coming or is it? Was one that we wrote just, back on August the 8th, right? So, I've been writing a lot of articles kind of questioning this theme of the market, this kind of no landing type scenario. Is that really a valid point? This weekend's newsletter, by the way, I'm going in to the link between oil and inflation and economic growth and all those type of things, because there's been a lot of talk over the last couple of weeks that, rising oil prices is going to lead to a massive surge in inflation. Not really, because inflation is only about 7% oil and we strip that out. So, what really drives inflation? We talk about that. But we do look at the economic link between oil prices and what happens in the economy. So that's in the newsletter this weekend. But today's blog, so every Friday we produce what we call a macro blog, a macro view blog, and kind of touch on some of these bigger kind of overriding economic data points. And so while I was chattering there with you for a second, I was actually pulling up the article so I could just share some of the charts with you. So the first thing is that this is the Citi Economic Surprise Index. And, so you can see in 2022 through July of 22, the data was vastly really disappointing what economists were expecting. So naturally, when the data keeps coming in a lot worse than what you were estimating, because again, going into 2022, everybody was super bullish. We're just going to keep growing. Don't worry about what the Fed's doing. It's all good. This economy is super strong. So nothing's gonna derail this train, right? This party's going to keep going. So economists were bringing it. The economy's going to grow at 6%, or ISM is going to be at 58%. And so the data, as the economy was weakening, was coming in a lot weaker. So not surprisingly, these estimates, these surprises were coming in to the negative side. Well, beginning in really July of last year, the economic data has been a lot better than everybody, because everybody got super bearish. All the economic analysts got very bearish. They were coming in with very low estimates. And now the data is beating them. So obviously, since we're all humans, if I'm getting beat every month by the economic data, what am I going to do? I'm going to start ratcheting up my estimates. And so now we've gone from definitely having a recession back in 2022 to, well, obviously, look how good the economic data has been. No recession whatsoever now. And that's the cycle that we've been in. So now, this is what we talked about earlier. Now we have the potential for the economic data to start disappointing again as we go forward. But this all is going to lead us into this conversation about GDP versus GDI. Yep. So GDP as a function is the gross domestic product. So this is a measure of, how do we calculate GDP? It's almost 70%. It's like 68% personal consumption expenditure. So it's what you and I do. The rest of that, so let's just say it's 70, just easy math. The other 30% of the economic equation is business investment, government spending, and imports less exports. So it's net exports. And so that's how we calculate GDP. We also take a look at, and this doesn't get any type of coverage whatsoever, but is gross domestic income, which is the income that's produced in the economy. And so logically, and we're going to get into charts on this in a second, but just logically in your mind, income and production should probably be pretty close in nature since one goes to the other. We're going to talk about this in more detail here in a second. But if we take a look at, and here's the important part about the debt we talked about earlier. Everybody keeps expecting we're going to have these stronger rates of economic growth in the future. The market right now and economists are saying, oh, we're going to start growing at 3%. Lots of talk recently about the neutral rate needs to go from 2% to 3% because the economy is going to be growing a lot faster now. So the 2% neutral rate, which is where interest rates and the economy are kind of neutral, they're not impeding each other and they're all kind of operating normally, that needs to be moved up. Right. And so at the recent Jackson Hole Summit, Jerome Powell said, no, we're staying at 2%. That's our rate. And the reason for that is the debt. And what you'll notice is that when we had very low debt levels back in 1947 through really the late 80s, the economic growth rate was about 3.2% real. That's after inflation for a very long time. And that was until 2007. And then after the financial crisis, we started growing again. But that growth rate went from 3.2% to 2.3%. Then after the COVID crisis, we're now going to step that rate of growth down again to probably somewhere sub 2%, 1.8, 1.9%. And this is just a function of the increasing of debt over time and the impact that debt has on economic growth because it diverts income and production away from productive sources that create economic growth to debt service, right? So this is why we keep having these slower rates of growth and why we will continue to have slower rates of growth as we continue to increase the debt. Okay, but let's get back to GDP and GDI and all this other stuff. So when we start talking about the economy, there's an important relationship you have to understand, which is the function of production versus consumption. So I just told you that 70% of GDP is based on consumption. So that's what you and I spend every day. So real quick before we get there, if we take a look at financial conditions and the economy, so gross domestic product, if a lot of our economy is debt driven, then we can take a look at financial conditions in terms of lending standards and interest rates and see that every time that financial conditions have been this tight, now the red line is lending rates and interest rates inverted. So whenever there's been a big decline in that index on an inverted basis, GDP follows exactly what you would expect. Because if I can't get credit, and I'm a debt-driven society, if I can't get credit to spend money, then consumption has to fall. And so this is where we get into this relationship of GDP versus GDI. So in order to consume, now this is the only lesson, Economics 101, that you need to take away from today's speech. In order to consume, I have to produce first, right? I've got to get up in the morning, and I know Gen Zs won't like to hear this, but I've got to go to work from 9 to 5. I've got to earn a paycheck. I get this little magical deposit of digital currency in my bank account, and then I can go buy stuff, right? I can go into Amazon or I can go out and have an experience, whatever it is, but I got to produce something first in order to consume. Now, once I consume, that generates the revenue for companies from which those corporate revenues generate earnings. As I'm getting an increased level of earnings growth because I'm producing more, now I'm consuming more, so companies are having more demand. They go out and hire more employees to meet that demand. That change in demand also requires me to pay more in wages, et cetera, so that I can continue to hire people in order to produce more product. And then as those people produce more at higher wages, they consume more, so forth and so on. And this is the virtuous cycle of the economy, but production comes first. So when you start thinking about things in this manner, and then coming back and now talking about the economic deficit and what's going on, if I'm using debt to supplant the production side of the equation, in other words, I'm just giving money or I'm printing money to create activity, that activity has a very short life in nature. So it works temporarily to create this productive movement, right? So we've got this Inflation Reduction Act going on right now. So we're running out building property, plant, and equipment. That's great. We're creating some jobs short term. But when that, building roads and bridges are fantastic. But once that job is done, there's no more production.
The sugar rush is over. Yeah.
Right. So that's why that continues to fail. What we need to be focusing on is things that produce more productive income. So now this is like I said, order
ongoing productive income, sustainable productive income.
Right. And this is the important part. That's a full-time job. Right. And so when we take a look at a lot of the job growth that we've seen, we've had a lot of part-time job growth. We've got workers that are working 3 part-time jobs instead of 1 full-time job. Well, full-time jobs pay more than even multiple part-time jobs. And so to create a sustainable standard of living in the economy, we need more people working full-time. Well, we've only got 50% of the working age population working full-time right now. And that's actually on the decline over the last couple of GDP employment reports. We haven't even gotten back where we were full-time employment-wise in 2019 before the economic shutdown. So, we talk about how strong and robust the employment recovery has been. It really hasn't. All we did was put all the people back to work that we laid off full-time. We've hired them back. When the administration says, oh, we've created 12 million new jobs. No, you didn't. You just put 12 million people back to work that you forced out of work when you shut down the economy. That's not creating economic prosperity. And so when we start, again, moving this forward, now we're talking about incomes and production, right? So the gross domestic income side of the equation is where people are working and they're generating activity. And at gross domestic incomes, it has consistently been underperforming the gross domestic product on an inflation adjusted basis. And importantly, since the fourth quarter of last year and so far 2 quarters of this year, that gross domestic income has actually been negative versus the gross domestic product. And that is not sustainable long-term. So, so let's get into some of the charts that really show this. Again, as I said earlier, it's not surprising to see that gross domestic income, since income comes first and then we can go consume stuff, that income and production track very closely. The differential between the incomes and the black line is all the other government stuff, right? Look at that divergence that we've had really since the fourth quarter of 2022. That gap is unsustainable. So either we're about to have a massive surge in employment growth and that will allow incomes to catch up with the economy, or gross domestic product, the economy is going to have to slow down. And we can go back through history. So this chart goes back to 1947. It looks at the gap. So has there ever been a gap before between GDP and GDI? Yes, it has. And if we go back and look at the 3-quarter growth rate of the gap between GDP and GDI, we are now at the highest level on record. But importantly, when we go back and look at previous periods where you've had such a spike between GDP and GDI, it wasn't GDI catching up with GDP. It was a recession that caught GDP down to GDI, right? And so this is just another one of those really, really good indicators. And again, when you look at the probability of recessions, looking at yield curves and all these other type of things, even though we're not in a recession yet, and I'm not saying we are, but all of these indicators suggest that the probability of a recession remains very high. And that gap between GDP and GDI is just another one of those indicators that suggest that at some point down the road, the economy is going to have to play catch up. And again, we look at financial conditions. This is based on the spread between the 10-year treasury and the neutral rate. That is also at a level that historically always precedes recession. So again, it's just a function that the economy is driven by a lot of artificial short-term stimulus that ultimately is declining and will evaporate from the system, yes, it's keeping the economy in a growth trajectory for now. But as that liquidity evaporates from the economy, reality will play catch up and you'll eventually have a recession. But again, as I've said before, probably not till 2024, maybe even early 25, by the time we get all that excess liquidity out of the economy.
Okay. So I think very important data series. That's why this is actually why David Rosenberg, says that he thinks we're in a recession now, because the classic definition is back-to-back quarters of negative GDP growth. He says, well, I'm doing it by GDI because I think GDI is more realistic here. And you just showed we've had actually 3 consecutive quarters of negative GDI growth. All right, so back to the arc that I described earlier of we get some remaining last hurrah in the markets, then something breaks, and that's going to require the central planners to intervene. You're basically saying it's just more data points here that something's going to break, right? This divergence is highly likely going to be, history's our guide, going to be GDP falling to catch up to GDI versus the other way around.
Yeah. And listen, this is our whole thesis on why interest rates are going lower, not higher.
Right.
And I don't have time to get into it today because we're running short on time here. But if you go to our website, realinvestmentadvice.com, and read our newsletter this weekend, you can subscribe on the front page of the website, and I'll email you the newsletter. This weekend's newsletter is covering the link between the oil and the economy, but there's a video clip in there that Michael Leibowitz and I did this week, explaining why we sold TLT and bought a 20-year Treasury bond, and all the reasons behind it. We've been talking about this here on the show for the last couple of weeks that we were going to do this transaction. That was our trade this week that we actually did. And so if you want the full kind of explainer video, it's actually in this weekend's newsletter on our website at realinvestmentadvice.com.
Great, folks. You should definitely go watch that. What bond did you buy?
It's actually a 20-year duration bond, fairly newly issued. It's been aged, so it's about 2 months old, I think. Bought a slight discount to par, which gave us about 4 5/8 yield to maturity.
Okay. All right. All right. Gosh, just so much to talk about, so little time.
Yeah.
We'll get to your trades in just a second. One of the points I wanted to bring up here, and this is going to reference an article that you wrote about a week ago. When I got some really good life advice when I was graduating Stanford Business School. We had a dean there, super popular. The dean of the business school was a guy named Michael Spence, who then later on was recognized by the Nobel Committee. He actually won the Nobel Prize in Economics for research he had done prior to becoming dean there. But just a really nice guy, really smart, obviously. Really cool, too. He was the dean that would leave school early on a Friday to go windsurfing. Just a cool dude. But I remember it was right as we were getting ready to graduate, and he kind of just, he spoke to us, but basically just said, look, your journey here is kind of over. I'm happy to answer any questions. And one question that he was asked was this guy who said, hey, I'm trying to decide between these 2 offers, and the one that I'm really leaning towards, I'm really excited about it, but it's in an industry that I haven't worked in before, so I'm going to have to, I'm taking the risk that I'm going to have to learn it, and hopefully that goes well, but who knows? And my wife and I, we're going to have to move cross country for this job, and my wife and I are now, thinking of starting a family. And so I'm trying to figure out whether I should take that or take this other job that's safer because it's kind of close to what I was doing before I came into business school. And Dean Pence said, look, I'm generally biased towards encouraging people to take risks. He said, that's how you actually, you get gains is by taking a risk, right? Taking a smart gamble on something. But he said, I am against taking too many risks at once, right? If you load yourself up with too many risks, you definitely begin to multiply the danger of, one or more of them going awry. and then kind of ruining the prospects of everything for you, right? So sort of this, risk management lesson, right? And that really stuck with me. And it's almost kind of like, the Powell doctrine in terms of using military force, where he's like, generally you don't want to use it, right? You want to try not to get in the fight if you don't have to. But if you have to get in the fight, like line up everything to your advantage, so that when you come in, you just come in hard with everything you got that's is highly likely to overwhelm the other guy, right? Just stack everything to your advantage, right? So I think that is a good approach to taking risk in investing. You might have a difference of opinion. I'll let you chime in on it. You're kind of nodding as I'm saying this. But you wrote a piece where you said, when people talk about average returns of the market, if you strip out the 10 best days during those periods, the returns tend necessarily not to be all that great, right? So there's a couple of days that are just working super extra hard, and you can't thump your chest too much about how great an investor you are, because you've got those 10 big days really pulling you up. And you said, look, as an investor, you may actually have a better return if you focus on trying to avoid the 10 worst days in the market. So let me hand the baton to you here, and that I've sort of set the context up here for this. But it seems like actually by being conservative, you can actually get better long-term returns.
So, but no, this is, that's absolutely right. And I have to write this article about once a year, because it's almost without fail that as soon as you get into a bullish trend of the market after a correction of any magnitude at all, somebody writes this article about, well, you just need to buy and hold because, if you miss the 10 best days of the market, you vastly underperform the S&P index. Well, what they never tell you is, and again, if you go to our website, we've got this article. It's the meme of the 10 best days. What they fail to tell you is that if you miss the 10 worst days, you increase your returns by 4.5 times. And the reason is that the best days of the market happen when? During the worst periods of the market. When did we have the best days of the market in 2020? It was during that 35% decline. We'd have these rallies of 4 and 5% in a day in the market. Then the next day, the market's down, 4 or 5% the next day. And so these best days of the market that you're not ever supposed to miss, first of all, they're random, but most of the time, they're always in the midst of a bear market, exactly when you don't want to be invested. So that's why if you just focus on missing the worst days, your returns are going to be so much better. So being conservative, and this is why value investing outperforms growth investing over long term. Because if you pay for value, you get rewarded over time. In the short term, buying growth and momentum will make you money short term, but it's going to wind up costing you more than you gain when the correction comes. Value won't do that to you because money during corrections, during bad periods, money rotates into value. So this is why conservatism always works better. Active management to avoid downturns in the market is key to long-term success. Getting back to even is not making money. And, this is the thing that always fascinates me about the mainstream media. Look, they're selling you a product. They just want you to buy an ETF and hold it so they can charge you a fee. And that's fine. That's the business, right? So they tell you these stories about, just buy and hold because you're going to do so much better over time. And you really don't. There's some great managers out there, mutual funds, that have killed the markets over time. And Peter Lynch and so many others. Berkshire Hathaway has killed the absolute return of the market over time. And they're not passive. They're actively buying and selling companies and managing risk and making bets on the market. But importantly, what they focus on is about not losing capital. It doesn't mean they never lose capital. It doesn't mean that prices don't decline. It just means they work to avoid big declines, big declinations, and destruction of capital. Because if I spend 4 or 5 years getting back to even, that's fine. But I've gotten back to even, yes, after 5 years. So I'm back to where I was. But that 5 years of not making my 6% growth puts me 35% behind the market on a compounded basis. So, those are the things that nobody tells you. So this is why it's important. Don't focus on your portfolio from January to September. That means nothing. Look at your portfolio of where you are today. Don't worry about what the market's doing. Look at how you're positioned for returns over the next 10 years, next 15 years, next 20 years. Manage that risk. And yes, some years you're going to underperform. some years you're going to outperform. And the key years that you really want to outperform are when the market declines 20 or 30%. That's the biggest separator between making long-term wealth versus not.
All right. And this is why I think if you're working with a financial advisor, which I think most people should do, and I'm going to make that claim as I always do at the end of this video too, but that risk management should be such a key part of the decision-making that you use when choosing an advisor. You know, as Lance alluded to earlier, you know, most advisors out there, one, you know, don't have the depth of experience of a guy like Lance. And they generally have the mindset of, oh, no, market will take care of you in the long run, right? So I'm just going to keep you fully invested all the time because over the arc of your life, if markets will go up, right? And not that that's necessarily untrue, but the point is that you can have a much better return and hit your goals a lot sooner if you deploy good risk management.
Yes and no to that statement. And let me give you a couple of good examples of what I mean by that. You know, most people, when they start seriously saving for retirement, they're 35-ish, maybe 40-ish, right? And because think about what goes on prior to 35, right? You're getting married, you're having kids, sending kids to college, buying a house. There's not a lot of money to save, right? People don't really get serious about saving and investing for their future until they're 35 or 40 years of age, okay? So now let's tack on 20 years to that. So I'm 35, I'm gonna retire at 55, right? So 20 years. 40, I'm going to retire at 60. I'm 45, I'm going to retire at 65. So people on average save about 20 years, right? So this is why it's so important to understand about your starting point when you start investing. If I started investing in 1960, I lost money for 20 years. So I had less money on an invested basis when I got to 1980 than I did in 1960 when I started. If I started investing in 2000, 20 years later, I barely had any more money than I started with. I'm not anywhere close to ready for retirement. And that's assuming I didn't sell out at the bottom of the market every time. So buy and hold in a theory works great as long as you happen to be starting at a point in time where you had depressed valuations, you have a big blowout in the market, 2008 as an example. You had a big blowout in the market. And now you got kind of the wind at your back, so to speak, for a recovery that allows buy and hold to work. Buy and hold has absolutely worked since 2009. Didn't work worth a damn from 1990 through 2000. So it's all about your starting point. If you're going to do buy and hold, just understand it's all about where you start the process.
Right, which is sort of like saying it's all about luck because you have no idea.
Yeah.
You have no idea what the next 20 years are going to do, right?
Yeah.
All right. Well, look, we're here at the end of the time again, Lance. A lot of topics I didn't get to. We'll just push them off to next week's video. Real quick, though, what trades, if any, did you guys make this week?
What I told you. The only trade we made this week, because it took us all week to put it all together, was the bond swap. So swapping TLT for an individual bond. Now, if you're a SimpleVisor subscriber, we in SimpleVisor, which I show you here from time to time on the show from a lot of our research and analysis platform that we have. In that model, which is a live account, by the way, it is actually a live traded portfolio that we replicate on the website. We had to swap TLT for EDV. And the reason is that we don't have an active data feed for a specific bond that will give us the daily price changes. So, and again, depending on when you start, you won't be able to buy the same bond that we bought. So it makes it very confusing on the website. So on the website, we swap TLT for EDV, but in our client managed portfolios, we actually swap TLT for an actual individual treasury.
Okay. Thanks for clarifying for that. If anybody has any questions, I'm sure they can just email your team there at RIA.
Sure.
All right. Well, look, as we wrap up here, just want to remind folks that the Wealthion Fall Online Conference is coming up next month, Saturday, October 21st. Ticket sales have actually been going great so far. So if you are thinking about going and haven't registered yet, highly recommend you do so soon because you want to lock in that early bird price discount of almost 30%. And if you're an alumnus of our previous conferences, check your email inbox. You should have a code from me that'll let you get an additional 15% discount on top of that 30% early bird discount. But those aren't going to last forever. So make sure you both lock in your seat and lock in those discounts by going and registering soon. Just a great lineup there. anyways, I won't go through all the names right now because we're short on time. But if you want to find out who's going to be there, what they're going to talk about, go to wealthion.com/conference. Has all the information there as well as how to register. And then just as I do every week, and Lance did a great job explaining this multiple times in this discussion, highly recommend that most people watching this video, because you don't have the expertise, the time, the market experience that a guy like Lance and his team there at RIA have, but you also have a real life, right, that you got to deal with. You got to go to work, you got to focus on your family, etc. Highly recommend that most people approach their wealth building journey by following the guidance of a good professional financial advisor. Obviously, you want them to be good, but you also want them to be steeped in all the macro issues that Lance and I talked about here. And there really aren't that many that do that well, and there are many that don't do it at all. So anyways, if you've got a good advisor who's doing that for you, great, stick with them. But if you don't, or you'd like a second opinion from one who does, maybe even Lance and the team there at RIA, set up a free consultation with one of the financial advisors that Wealthion endorses. To do that, just fill out the short form at wealthion.com. Only takes you a couple seconds to fill out. These consultations are totally free. There's no commitment to work with these guys. It's just a public service they offer to help people get as prudently positioned as possible in advance of some of this, these fundamentals finally mattering that Lance and I have been talking about here. And if you enjoy hearing Lance and I bat around the intellectual football a week after week after week on this channel and want to hear more of it in the future, show your support for that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Lance, as usual, you get the last word.
The only thing I say is that if you are interested in the bond trade and why we did it and kind of the reasoning behind it, there's about a 15-minute video clip that will be in this weekend's newsletter. So if you go to realinvestmentadvice.com, again, shameless plug, but if you want that video clip to really kind of, Mike Leibowitz and I really kind of dig in depth into all the reasonings behind why we made the swap now, both the economic side of it as well as the portfolio side of it, that will be in this weekend's newsletter. We'll email it to you for free if you subscribe. If not, you can download it right at the website on Saturday.
All right, buddy, thanks for another great week. Wish you well. See you next week. Everybody else, thanks so much for watching.